Hello friends, so today we'll start with Ind AS 33 that deals with earnings per share, a very important standard and easy to calculate. Some cases it can be complicated but very important and highly scoring as well. A lot of these things, so whatever you have learned at your CA intermediate level, you can use similar concepts, but some specific terminologies, some specific treatment we need to be careful about, right? Now when we talk about earnings per share, what we basically means is what is the earnings of the entity. How to calculate that earning, we'll come to it, divided by number of shares. Now here when we are saying shares, we are referring to something called as ordinary shares, which we also call as equity shares. But India uses the term ordinary shares in line with the international standards, right? So whenever we say earnings per share, we calculate for what we normally understand as equity shares, which is nothing but our ordinary shares. Now, when we say number of shares, here we need to, when we say number of shares, here we need to talk about weighted average number of shares. How to calculate that, we will come to it. Earnings are basically your net profit after tax, subject to some adjustments for preference dividends. Some cases we need to deduct, some cases we don't need to deduct. All of that we will understand. This is the basic formula to calculate what we call the basic earnings per share. Right? Now, ordinary share that I told you about is basically an equity instrument that is subordinate. Subordinate means that is junior or that is last in line to all other classes of equity instruments. Right? So you can have more than one class of ordinary shares, and if we talk about one particular class, each class has same rights. If you have different classes, accordingly you will also calculate earnings per share for each of those classes. Then we also have something called as diluted earnings per share, for which we have to know something called as potential ordinary share. This also we'll understand as we discuss further in the standard. So when we calculate basic earnings per share, this is the formula you have to keep in mind. This is profit or loss attributable to equity shareholders, what we also call as ordinary shareholders, divided by weighted average number of equity shares outstanding, weighted average number of equity shares outstanding or ordinary shares outstanding, that is the denominator. So you need to calculate the numerator, you need to calculate the denominator. Now when it comes to numerator, what we need is profit attributable to our equity shareholders. Now how do we calculate that? Basically you will take profit after tax. You will start with profit after tax. Okay, you will start with profit after tax. From that you will reduce any dividend on cumulative preference shares. So if it is a cumulative preference shares, whatever is the dividend that has to be paid, that you will consider here. You will deduct it from the profit after tax. Then if there are non-cumulative preference shares, you will deduct the dividends only when they are paid. Okay, only when they are declared. Only in that case you will deduct the non-cumulative preference shares dividend. Then there are some other adjustments to be done in case of preference shares that we'll understand. But apart from these, basically dividend and for both cumulative and non-cumulative preference shares. Cumulative always, non-cumulative only if they are declared. Okay, so one thing you have to keep in mind, if this is already there as a part of finance cost, when we treat preference shares as liability and we charge finance cost on that, you don't do double deduction, you only do deduction once, right? So that is how we calculate the profit attributable to equity shareholders. Basically, what is the amount of profit that we will pay to equity shareholders? So that is attributable to preference shareholders. That is what is calculated here as a part of your earnings available to equity shareholders or ordinary shareholders, right? Now when we calculate, as I told you, cumulative always deduct, non-cumulative only when declared. Then there are some specific items that we need to handle properly when we calculate EPS. First one is the concept of increasing rate preference share. Now what is the meaning of increasing rate preference share? Initially I will give low rate of dividend, subsequently I will give high rate of dividend. In that case, how should we handle? Because what happens, initially you will have low dividends, subsequently you will have high dividends. That is what is called a higher rate or an increasing rate dividend. Now for an increasing rate dividend, what we do is, if there is any issue discount or premium on such shares that is amortized using the effective interest method as per Ind AS 109. So whatever is the discount or premium on these type of increasing rate preference shares. For example, I tell the shareholders, I will give you low rate dividend initially. Subsequently, I will give you higher rate dividend, and I will also redeem it at premium. I will also redeem it at premium. So that premium is amortized using the effective interest method, and this premium is considered to be a preference dividend for the purpose of calculating earnings per share. So basically what it means is, whatever is the discount or premium, if I am issuing, let us say 100 rupees preference shares at 90, this particular discount, or I'll redeem this at 105, this particular 5 of premium, that will be amortized and it will be treated as preference dividend for the purpose of calculating earnings per share. So what it basically means is, I will reduce that from my profit to calculate the earnings per share, or to calculate the earnings, right? Then if shares are redeemed at premium, now again, if the shares are redeemed at premium, then what does it mean? This means that we are paying more amount to the shareholders. We are paying higher amount for shareholder. Now, when we are redeeming it at premium, we don't debit this to P&L. Under amortized cost method or under effective interest method, we will debit it to P&L. But let us say if that is taken to retain earnings, the premium part, when it is redeemed, then in that case, this premium, whatever is the premium that I am paying extra to my preference shareholders, that is also nothing but something like my dividend paid, and it is deducted in calculating profit or loss attributable to ordinary equity holders. So for increasing rate preference dividend, that is also deducted. If there is premium on redemption of preference shares, that is also adjusted, right? Then if there is early conversion of preference shares at a premium, even in this case, you will deduct it while calculating profit or loss attributable to equity shareholders, right? Then sometimes what happens is, the amount of preference shares and the fair value of consideration, there is a difference. For example, you pay the carrying amount of the preference shares is 100, fair value of consideration is 90. So we are paying less, which is a gain. Now this gain is added in calculating the profit or loss for the ordinary shareholders. So basically what it means is, we will add it back because we are paying less, and because we are paying less, we are making a gain. That gain is considered as a gain and it is added to equity shareholders earnings, right? Then if there is preference dividend which is subject to tax, these days we don't have dividend distribution tax, hence this doesn't have much of relevance. But if there is a tax, you will consider after tax amounts while calculating the earnings available to equity shareholders. Right. Now one thing you have to keep in mind, let us say we are talking about year 1 and year 2. Year 1 there is a cumulative dividend of 100, you have already deducted this. In year 2 you have paid that dividend. Again in year 2 you will not deduct. So same thing, basically you will not deduct it 2 times, right? So that is as far as earnings is concerned. The second thing that we need to understand is something called as weighted average number of shares. Now what is this weighted average number of shares? We will take one example and do it off. So weighted average basically means, because shares may be issued at multiple times during the year, you may have a different opening balance, you may have a different closing balance, shares are issued during the period and all of those things. Because of that, you don't take only the closing balance, you calculate something called as weighted average number of equity shares or weighted average number of ordinary shares. The reason is, because they have been issued at different points in time, we will calculate the time based weights and do the working. Now here let us see. We are looking at year 1, year 2. On 1st of April, opening balance is 1 lakh. On 15th of June, 75,000 has been issued. Now, please understand, whatever you have issued on 15th of June, that is not outstanding for the entire period. Whatever you have issued on 15th of June is outstanding only for the remaining part of the period. So, whatever you have issued on 1st of April, this 1 lakh, This is outstanding for 365 days. So this represents 1 lakh shares. Whereas whatever you have issued on 15th of June, from 15th of June till 31st of March, it is outstanding only for so many days. So 75,000, whatever is there, you will calculate the number of days, divide by 365, and then you will get this factor. Then if there are, conversion of preference shares into equity, so from the, when it is being converted into equity, again, this also we need to consider for calculating the weighted average. Same way, buyback, and then accordingly we will see what is the weighted average number of shares outstanding, right? So here if you see, this 1 lakh shares is outstanding for 365 days, so the weighted average shares is 1 lakh. 75,000 is outstanding only for 290 days. Why? From 15th of June till 31st of March. You can do the counting on your own. It is outstanding for 290 days. So 75,000 into 290 divided by 365, 59589. In examination, normally you can do months basis also. But here, because some fractional dates are given, we are doing by 365. So why not 366? We don't know whether it is leap year or not, right? Then conversion of convertible preference shares into equity on 8th of November. So from 8th of November till 31st of March, how many days are there? 144 days are there. So 50,000 into 144 divided by 365. Then buyback of shares means shares have been bought back. Now when you buy back the shares, number of shares go down. So how many shares? 20,000 shares have been bought back. That is why it is given in negative, or we consider negative number, right? Then how many days? From 22nd February till 31st of March, 38 days are there. So this into 38 divided by 365, you have 2082. When you sum this up, what you get is your weighted average number of shares. Now what I'll do is I'll put up the Excel. So here there are two ways to calculate. One way we saw what is given in the material. Another way also is there to calculate. Whichever way you are comfortable with you can do it, right? So here if you see, date opening balance is on 1st of April. So let us say 1st of April of year 1. Okay, 1st of April of year 1, 1 lakh. Okay, so this is the number of shares. Closing or cumulative balance is also 1 lakh. And when does the next date, I'll put it here. When does the next change happen? 15th of June of year 1. What does that mean? That basically means that this 1 lakh shares are outstanding from 1st of April till 15th of June. The next change happens on 15th of June. So number of days, 15th June minus 1st of April, year 2. I'll take year 2, otherwise there will be a leap year issue. Okay. So basically it means for 75 days we have 1 lakh shares. So what is the weighted average? 1 lakh into 75 divided by 365. Okay. Then on 15th of June, what did we do? We issued equity shares 75,000. Now the closing balance is 1 lakh plus 75,000. Number of days. Now when did the next change happen? The next change happened on 8th of November of year 2. So the number of days are 146, means from 15th of June till 8th of November, 146. Weighted average comes out to 70,000. Then on 8th of November, conversion. How many shares? 50,000 shares. So closing is 225. And when does the next change happen? 22nd of February of year 3, the next change happens. So the number of days are 106. Weighted average is 65,000. So basically 22,500 into 106 divided by 365. On 22nd Feb, what happened? Minus 20,000. How much? So now the shares are 2,05,000. How many number of days? See, we are ending year on 31st of March of year 3. So number of days is 37. But if you do the total, here you get only 364. Why? Because we need to also calculate or include 31st of March. So 38 days, and that is 21,000. So if you do the sum of this, what you get? 177 to 32, right? Now what did we get in our other calculation? 177 to 33. So either ways you can do. Either you can see these number of shares are outstanding for how many days and accordingly do the calculation, or you can do this basis where you see, okay, this changed, then this shares changed, then this shares changed. and accordingly you can do the calculation. Either ways is fine, both the ways are acceptable, there is no problem. Okay. So that is how we calculate weighted average number of shares. So when we calculate weighted average number of shares, you take the opening balance, weighted average of shares issued during the year, bonus issued. Now one thing you have to understand, I'll not go into the logic in too much of depth. When we talk about bonus issue, what we need to understand is, for bonus issue, you will not take time weighted factor. You will assume that these were issued at the beginning of the year. These were issued at the beginning of the year, because when there is a bonus issue, there is no inflow of money. When there is bonus issue, there is no inflow of money, and hence you will take it from the beginning of the year. So even if the bonus issue happens of, let us say, in June of year 24, you will assume that this has happened on April of 24. Even previous year numbers will be restated based on the bonus issue. Okay. Then rights issue, for this we need to calculate something called as theoretical X rights price and the right adjustment factor we will consider. And if shares are bought back, it is just the opposite treatment of when the shares are issued, right? Now this is the broad framework in which you will calculate the weighted average number of shares. Now when we talk about the date for the purpose of calculating the weights, what we need to understand is, if it is issued in exchange for cash, if you have issued shares for cash, then the date on which cash is receivable, not on the date from which cash is received, from the date on which cash is receivable, from that date you will consider it for time weighted factor. Then if there are reinvestment of dividend on ordinary or preference shares, so if the investor says, or if there is a practice in the company that the dividends that are issued, they are reinvested and shares are issued in place of that, the date of reinvestment. Generally this is not seen in practical life, at least in India, right? Then if there is a debt instrument which is converted to equity shares, when the interest ceases to accrue and when the when the date of allotment. If it is in place of interest or principal on financial instrument, when interest ceases to accrue. Okay. So if there is a conversion, the date on which interest ceases to accrue, that is basically the date of allotment, from that date you will consider the time weighted factor. If it is in exchange for settlement of liability, whenever you have settled. So for example, if I have issued shares to settle to my creditors, the date on which the settlement happens, from that date I will consider it to be for the purpose of my time weighted factor. Then if it is for acquisition of an asset for other than cash, when the asset is recognized. For example, I have acquired PPE and I have issued shares. So date on which I have recognized PPE, on that date from that date I will recognize the time weighted factor for the equity calculation, weighted average purpose. Okay. Then if it is a part of consideration of business combination, from the date of acquisition, and if it is conversion of a mandatorily convertible instrument, from the date of entering into the contract. So now here, when there is a mandatorily convertible instrument, which means I have issued debt and this will be compulsorily converted, which means I know from day one that this will be an equity instrument, and hence from the date of entering into the contract, I will consider it for the purpose of calculating weighted average number of shares outstanding. So one thing you have to keep in mind, this keeps on coming up, bonus. If it is a bonus issue, there is no time weighting factor. You will not calculate the weighted average. Then, so far we are talking about only basic earnings per share. We have not yet come to diluted earnings per share. And if there are shares which are contingently issuable, means what? If some contingent conditions are satisfied, then we will issue those shares. So till the time these shares are issued, they will not be considered as as entering into EPS calculation. But if all the conditions are satisfied, after which what happens? We have to compulsorily issue those shares. When all the conditions are satisfied, then from that date we will include in the calculation of basic earnings per share. If shares are issuable after passage of specified time, they are not contingently issuable, because passage of time is certainty. So if there is something like we will issue shares after 3 months, those are not contingently issuable shares, those are normal shares only. Whenever we issue those shares, at that point of time we will include it. But If these are contingently issuable shares, you will include that in the calculation of basic earnings per share when all the conditions are satisfied. Then, if there are contingently returnable shares, now contingently returnable shares means what? The shares will be returned on satisfaction of certain conditions. Now these kind of shares are not treated as outstanding shares and are excluded from the calculation of EPS. Means if there is a contingently recallable share, we will exclude that from the calculation of basic earnings per share. When will we include it? Once they are no longer subject to recall. Means if they are no longer subject to those recall condition, from that date we will not consider it for recall. From that date we will consider it for EPS purpose. Okay. Now sometimes what happens is there is a change in number of shares without change in value of capital. For example, bonus issue. Bonus issue is what? From this pocket you have moved the reserves to another pocket. Now in that case, if there is a bonus issue or a share split where only the number changes, funds don't change. Funds don't change means we don't receive anything extra, we don't receive any extra money. So in that case, what happens is number of shares are increased but resources are not increased, and hence these are adjusted from beginning of the period. They are adjusted from beginning of the period. Okay. And same way, if there is a reverse share split, again from the beginning of the period. So here it is like 10 shares becoming 20. Here let us say 20 shares becoming 10. In both the cases, you will do the adjustment to the numbers as if the bonus had happened at the beginning of the period. If previous period is reported, this adjustment also is done in the previous period as well. Now, rights issue, very interesting concept that you need to understand. So let me just put it out here. So generally when there is a rights issue, existing shareholders get additional shares by paying some amount to the company, generally less than the market price. So let us say price before issue, what we call as cum rights price, is 20. Rights issue is 1:5. 1:5 means what? For you will get one share for 5 shares held. So if I need one right share, I will need to have 5 shares. Now this one share is issued at, let us say, 15. Right shares is issued at how much? 15. Okay. Now when I say rights is issued at 15 means what? If I have 5 shares of 20 rupees each, I can buy one more share at 15 rupees. So think of it. Investment before is how much? 20 into 5. 100. New investment 15. So the total investment becomes how much? 115. Now for me, what is the cost, or what is the break even cost, or what is the weighted average cost? Price per share is 115 divided by 6. See, earlier I had 5 shares, now I have one more share. So 115 divided by 6, it becomes 19.16 or 19.17. This is called theoretical X rights price. Means after the right issue is over, I would expect, without considering other market changes, that the price per share will be 19.17. 19.17. This is called theoretical X rights price. Now, please understand, if the company had issued shares at full price, they would have collected 20. But they have issued shares at discount. Means they are giving away something for free. So there we say there is a bonus element in rights issue. There is a bonus element in rights issue because we have given something for free. Now when we give something for free, when the bonus element is there, that part has to be retrospectively adjusted, or that part has to be adjusted from the beginning of the period. Now we don't need to get into too much of complex calculation. What we normally calculate is something called as right adjustment factor. Now with this right adjustment factor, what happens is you will be able to adjust the bonus component in a given rights issue. Now how do we calculate the right adjustment factor? Is basically 20 rupees in this case divided by 19.17. If you do 1.04 is the right adjustment factor. Okay, now what we'll do is we'll take up a question, apply that this concept in that question and solve that specific question. That will help us understand how do we calculate basic earnings per share when there is a rights issue. Sorry. At 31st December of year 1, the issued share capital of a company consisted of 1.8 million, that is 18 lakhs, ordinary shares of rupees 10 each, fully paid. The profits for the year ended 31st December of year 1 and year 2 amounted to 6,30,000 and 875 respectively. On 31st March of year 2, the company made a rights issue of 1 for 4. Means you need 4 shares, you will get 1 more share at 30. The market price of the shares immediately before the rights issue was 60. So price is 60, now we are issuing it at 30. Now how do we calculate theoretical X rights price? 60, I need 4 shares, I'll get 1 share of 30. So 60 into 4, 240, 30 into 1, 30. Now a total valuation is 270. For how many shares? For 5 shares. So 5 5s are 25, 5 4s are 20. Right. So 54 is my theoretical X rights price. Means if no other event happens, the price should come down to 54. That's why it's called theoretical. In theory, the price will be 54. Right. Now, what is the bonus element? I told you the right adjustment factor, that is cum rights price divided by theoretical X rights price. Cum right price is how much? 60. Theoretical X right price is how much? 54. So 60 divided by 54, that is 10 out of 10 by 9. You can divide it and do it, or you can keep it in fraction form only. So this is the right adjustment factor. Basically what it means is there is a 1 free share for every 9 share held. There is a 1 free share for every 9 share held. Okay, don't need to worry about this explanation. Now, how do we calculate this? See, we have 18 lakh shares. We have 18 lakh shares. Okay, and with the rights issue, we got 4,50,000 shares. How did we get 4,15,000 shares? 18 lakhs divided by 4. If you do, you get 4,50,000 shares. Okay. Now, when did we make the rights issue? We made the rights issue on which date? 31st of March. So we are taking December year 1. So we are calculating till December year 2. So we did on 31st of March, means after 3 months. So 1,80,000 shares were outstanding for 3 months out of 12. And after this rights issue of 4,50,000, 22,50,000 shares were outstanding for 9 months out of 12. Right. Now, 22,50,000 shares includes original shares, right shares. Right shares includes both bonus shares and also paid shares. Right. So this calculation is proper, but this 1,80,000 shares when I am issuing for this 1,80,000 shares which are outstanding from the beginning of the period, which is outstanding for 3 months, I also need to adjust this for bonus element for the remaining 3 months, because we said bonus element has to be considered from beginning of the period. So for this period I have to adjust the bonus element. How will I do that? Multiply it with the right adjustment factor. So 18 lakhs into 10 divided by 9, we get 20 lakhs, and that is into 3 out of 12. So 3 4s are 12, 5 lakhs, and 22 lakhs 50,000 into 9 divided by 12. If you do, you get 1687,500. So the total weighted average number of shares is 1687,500 plus 5 1 2 1 2 3, which is 2187,500. So this is how we calculate the weighted average number of shares when there is a rights issue. Okay. So 2187,500 is the weighted average number of shares. Now, this is the weighted average number of shares. Again, I am repeating, 18 lakhs into 10 by 9. Why are we adjusting this bonus element? Because the bonus component has to be adjusted from the beginning of the period. Sir, why are we not doing 10 by 9 here? Because this 2.25 includes both bonus shares and free shares. Okay, so this is 2187 and profit for the year is given, weighted average number we calculated, so EPS is 40 paise per share. Now what we also need to understand is previous period also we need to adjust for bonus. Previous period also we need to adjust for bonus. Now how do we adjust for bonus? Previous period original EPS is 35, that is 6 lakh 30 divided by 18 lakh shares. Now this 35 paise, what you will do is 35 paise multiplied by 9 out of 10 or 35 paise divided by 9 divided by 10. Okay, this basically, sorry, it is 10 by 9. So 10 divided by 9, basically 35 divided by, if you do 10 by 9, you get 1.11. So if you do this, you get 31.5. Basically, what you need to understand is whenever there is a bonus issue, the EPS will go down. Whenever there is a bonus issue, the EPS will go down. If there is a bonus element in rights issue, the EPS will go down. That is why here also 10 out of 9 means what? Number of shares goes up, my EPS will go down. So previous period when you have to adjust, just the reciprocal, you will either do EPS divided by the factor that we calculated or EPS multiplied by 9 out of 9 by 10, that is reciprocal of what we have adjusted, and that is how you will get the your basic earnings per share in case of rights issue. Now the steps that you have to keep in mind is, first step, calculate the theoretical X rights price. Second step, calculate the adjustment factor, or we also call it the bonus element factor or bonus factor, whatever name you want to give. Then from beginning to rights issue date, you multiply that with the bonus factor. After that you do the normal calculation, and previous period is equal to EPS as reported divided by the bonus factor or right adjustment factor. So that is how you calculate EPS when there is a rights issue. Right. So theoretical exercise price, we have already seen it, and we'll have to apply the adjusting factor for both current as well as previous period. Right. So till here we have covered the basic earnings per share related concepts. How do we calculate the basic earnings per share, and how do we handle the rights issue? Right. Now in next session, what we'll do is we'll see how do we calculate the dilute earnings per share. Now what you have to do is complete all illustrations up to rights issue. Okay. Tomorrow we'll take up diluted earnings per share and few more illustrations for our practice.